Welcome back. This session is going to be very interesting and most important. Every year in the month of February 1st, our finance minister presents the finance bill, and that will have a huge impact on the taxation aspects. In the previous videos, we had covered what are the various heads of income, like income from salaries, income from house property, income from business income. We talked about income from other sources, and then we talked about capital gains. So every year there will be some certain changes to the taxation aspect. So I'm going to cover that as well, and I'm also going to do a little bit of a recap. So let me start with first things first. Okay. Now, the quick recap I would like to tell you is that every year, like for example, let's say from April to March, which we call it as a financial year, typically, like most of the businesses prepare two statements. The first statement that they prepare is called for an income statement, which is prepared for a particular period. That means a 12 months period. Whereas balance sheet is a statement prepared on a particular date. Please understand, these two are most important financial statements which is prepared. And even as individuals, you and I, what happens is the companies, when we work for a big corporate, they give you something called Form 16. If you are going to work in India, they'll give you a Form 16 on the kind of salaries that you made, what are the various allowances you made, which is equivalent to an income statement, right? And another important recap which I would like to do is that all financial transactions, whatever you're going to do is that financial transactions will have an impact either only on the income statement or income statement plus the balance sheet. There will be certain items where only balance sheet will get impacted, and we always follow something called a double entry bookkeeping, and it will have two entries towards it. So I'll give you a few examples to that. Maybe that will help you to understand the whole thing. For example, let's say on 31st of March, right? Let's say I have a bank account, in my bank account I have, let's say 10 lakhs of rupees, and let's also assume that there is a loan which I have taken from one of the nationalized banks for 5 lakhs. So what I decide is that I try to go and repay the loan on 31st of March. What will happen is that there will be when I repay the loan, what will happen is on the balance sheet side, the cash or the bank account, whatever I'm having as 10 lakhs, will come down by 5 lakhs. Similarly, on the liability side, what will happen is the loan which I had for, let's say, whatever amount will also get reduced automatically by 5 lakhs. So this is called as a double entry bookkeeping account, and this is what happens. I'll give you one more example. Let's say I'm going to sell, let's say, 5 laptops on 30th of March. Now, what will happen is either I can sell it on the basis of cash or on the basis of check. Typically what happens is that in business you don't sell it on cash. Everything happens over a 30-day credit period or a 60-day credit period or a 90-day credit period. So when I make a sale, what will happen is that the income statement, there will be an entry called sales. In the sales, I'll say that I've sold 5 laptops, let's say 75,000. So 5 into 75,000, 3,75,000 will be there. Assuming that I'm going to sell it for, let's say, for a 60-day credit cycle, then the same amount will be listed as an accounts receivable in the balance sheet. So all that I would like to say is that when you get into the real life scenario, these kind of things will come to you. So please remember these kind of points. The next thing which I would like to say is that as an employee, I was talking about Form 16. Another thing which is very, very important is that in your payslip, as you start working in your payslip, what will happen is that you will see something called your gross salary components. Your gross salary components could be basic salary, house rent allowance, special allowance, meal allowance, vehicle allowance. So many allowances will be there. So that all put together is called gross pay. Similarly, there will be set of deductions. So once in 6 months, they'll deduct something called a professional tax, or every month they'll deduct something called a provident fund, your contribution towards your provident fund. And there is something called national pension scheme where you may also get enrolled, and 10% of basic salary will go. That will also go as a deduction. So what happens is, in a pay slip, what will happen is there will be two sets will be there. One set is the gross income, which is the list of 1, 2, 3, 4 components where the company is making the payment, okay? And similarly, there will be on deductions will be 1, 2, and 3, saying that this is towards your provident fund, this is towards your kind of Taxes is one of the important deduction, and when you reduce these two things, you will get something called a net pay. And it's very important in life that as you move forward, every 5 years or every 7 years, you should focus on doubling your net pay. That means, let's say I'm going to start with a net pay of, let's assume that 50,000 rupees, right? My objective should be in life should be that every 3 years or every 5 years, they should start doubling in. That's the way, like, how it will get doubled is that is, you start investing yourself in your education. The moment you start investing in your education, right kind of certifications and all that stuff, what will happen is your employability will go up and your earning capability will go up. By that, your gross pay will also go up. So this is another thing which I thought I'll just share it with you. And one more most important concept which I want to tell you is, I was talking about balance sheet. In a balance sheet, there is something called list of assets and there is something called list of liabilities. And the definition of net worth is nothing but sum of assets minus sum of external liabilities. When I say external liabilities, I am talking about money that I have to pay to the bank, the money I have to pay to the suppliers, those kind of things are called external liabilities. The difference of these two is called net worth. So from a business angle, our objective should be is to keep increasing this net worth year on year. That's very, very important. Another important aspect which I want to talk about it is something called as returns. When you talk about returns, most of the income, like that you're going to make, the government will be expecting a small portion of it, and this we are already covered. So you should also have something called what is meant by a pre-tax return and what is meant by a post-tax return. Pre-tax return is a very, very simple return. What is meant by post-tax return is, let's assume that I am in a 30% tax bracket. What will happen is, you deduct 30%, if I'm going to earn 100 rupees and the tax slab is 30%, so 100 minus 30, the net tax, post-tax, my return is only 70. So these things, I just thought I will do a quick recap. Another important thing which I want to talk about is inflation. When you talk about inflation, what happens is, in the US, during pandemic stage, what happened is, each and every citizen, in United States, got something called a pandemic allowance, right? Or a rebate. They also got, let's say, $1,800, per TIN number or an SSN number and all that stuff. So they started printing these kind of money. So when money gets printed in huge amount, and then when it gets circulated, there will be an inflation will be there, because the amount of goods that got manufactured is only X amount, whereas the money which is chasing the same X amount of goods has gone up. So too much of money following up, too few goods, is called as inflation. The other thing is that is, as I was talking about in point number 2, is that is, when your salary starts increasing because of your inflation also, what happens is that is, for example, when I started my career, maybe my basic salary would have been, let's say, 5,000 rupees or 10,000 rupees. Today, because of inflation, thanks to inflation or the purchasing power, what will happen is that is, even the basic salary when people start today will be 20,000 or 25,000. So all these things are contributed to inflation, right? And at the beginning of the call, I said, February 1st, a finance bill is being presented, and it got passed very recently. I would say about 10-15 days back. It got passed in the parliament, both in Lok Sabha and Rajya Sabha. So I just thought I'll give you an highlights of the finance bill 2023 from a personal finance perspective. The first thing is that is, we talked about old tax regime and new tax regime. Now, what I'm going to tell is that is, going forward from next financial year, I'm talking about 23 and 24, or the current financial year, or the next assessment year, 24 and 25, what's going to happen is that is, the new tax regime will be the default regime. The new tax regime will be the default regime. So, for example, if you're going to use Section 80C and all that stuff, it's important that you have to switch over to the old tax regime. For example, contribution to NPS, or taking a medical premium under Section 80D and all that stuff, or you're going to buy an apartment on loan and you're going to repay the loan and all that stuff. If you want to take credit under Section 24 and all that stuff, you should choose old tax regime. Otherwise, by default, the new tax regime will be applicable to you, but it comes with certain advantages. For example, up to 7 lakhs of rupees per annum, there is no tax at all, right? So you have to be cognizant about this fact. The second thing is that is debt mutual funds. Now what happened is that is earlier we had something called an indexation benefit. So we were talking about inflation, like even RBI comes up with something called CPI, inflation index, like every April or every May they'll come up with that one number. What happened is that is whatever money that you're going to make in a debt mutual fund, they gave an indexation benefit. But now what they are saying is that is like for example, if the debt mutual fund is predominantly of debt, okay, and there is no equity component at all, they said like it should be treated as a fixed deposit. It's a fair game, like it should be treated as a fixed deposit. So that means your slab rates, like it will be added to your income from other sources or whatever, and then it will be start taxed. So there is no indexation benefit will be there. So that is what they have covered. The third thing which they have brought in is that is like insurance. Earlier, like a lot of people go for insurance. We already told you that term insurance is the right type of insurance which you should look at an young age. But the moment you cross, let's say 45, 50 or 51, 52, 53 and all that stuff, maybe people go for something called guaranteed income, because like in another 10 years they will go and retire. They may be looking for money back policies and all that stuff. If they are going to do that, what the finance minister said is that is, if you are going to contribute more than 5 lakhs of rupees in insurance policies, the moment you are going to get back the money, on the day of money, getting back the money, you will be alive, like maybe at 8 years you will be alive and the money will come back to you. When the money comes to you, the additional money that you're going to get will be taxed in your hands, okay. So you should be careful by like doing some tax planning. I have already told you that tax planning is ethical, tax evasion is unethical. So I just thought I'll cover this particular point. The third thing is that is, for example, they've also brought in, they've increased the limits for presumptive taxation. What does it mean is that is, let's say I'm doing a small service business, right? Let's say like I'm having a small stationery store, and the turnover per month is 5 lakhs per month. I don't have to go for extensive audit and all that stuff. 75 lakhs is the gross income, and like and I'm going to take only by let's say Google Pay or by check or by credit card and all that stuff, no cash transactions. Then up to 75 lakhs, like you don't have to do taxation and all that stuff. Presumptive tax is the easiest one. But on the other side, if you're on the manufacturing of goods and all that stuff, even up to 3 crores, like they want to like ensure that you have to run the business smoothly. They don't want to put too many things into place. So they said, if you are not going to handle cash, then up to 3 crores also you can go into presumptive taxation. So these are the things which I thought I'll cover it. Maybe I'll cover 1 or 2 more points in this particular slide. Okay. So I would request you to download 2 mobile apps from your Google Store, Play Store or whatever, App Store or whatever. The first thing that you should be downloading is something called as Financial Calculator India. There, I mean, more than 50 lakh downloads has happened, and the other one that you have to download is the Financial Calculator. These two calculators will help you to take charge of your personal finance. My suggestion is that is like you invest time in learning these two simple tools. Maybe like both of them come with a little bit of advertisement. Maybe you may consider like I am not interested with them, but in case if you want, you can like get a lifetime subscription for these two. These two are excellent calculators. Now I'm going to use all these calculators for my next session as well. Okay. So there are 50 lakh downloads, so it's not a new, let's say it's not a brand new app or something like that. So a lot of people are using in this one. And the good thing is like, I'm going to reiterate that you will learn about simple interest and compound interest, the power of compounding, which we covered in the earlier sessions in a much better way using these two tools. And another thing is that is using financial calculator, right? You can also find out what is the future value of today's investment, what is the present value of this, and all that stuff you will be able to do it. So only thing is this Financial Calculator of India will have all the bank like deposit rates and everything. It will have post office rates. So those kind of things are available in this one. I would request you to download these two things and then get familiarized the whole thing. The next thing is inflation. Right, you want to find out like how much is the inflation, annualized inflation and all that stuff, you will be able to do it. And this like you can also use it for your loan, like for example, tomorrow you want to buy let's say a car, like a car for 10 lakhs of rupees, and then you give a down payment of 2 lakhs and there's 8 lakhs is there, and you want to identify how much is the EMI, right? So all those things you can do it, like or somebody says like I'm going to give you a personal loan of 2 lakhs and the EMI is let's say 2000 rupees per month and all that stuff. Now like you want to check, cross check what is the interest rate, you can do that using the loan calculator. And the last one is like I was talking about pre-tax and post-tax, you can also do that using the tax calculator. So my suggestion is that is download these two apps, right? Now, I'll give you certain examples. Through the examples, you can learn it. So, I'm going to use the financial calculator extensively for my examples. The first example I'm going to use is that is, one Mr. Vijay bought a 15-year-old or a 15-year-old 2 BHK, that is 2-bedroom hall kitchen apartment in Mylapore. Mylapore is a suburb in Chennai for 100 lakhs of rupees in the year 2018. And he sold the same flat earlier, like 2-3 weeks back, he sold it for 150 lakhs. So, we will all think that he made 50 lakhs of rupees as profit. Is that right? 50 lakhs of rupees as a profit. My question is this 50 lakhs came over a period of 5 years. So, we think that he would have made 10 lakhs each. The simple interest concept, if you apply the simple interest concept, we will say it's 10 lakhs every year, correct? 50 lakhs divided by 5 years. So, 10 lakhs, and how much is the investment? 100 lakhs. So, you will say the simple interest is something like 10%. The return on investment is 10% per annum. But the question is, what is the compounded annual growth rate, or what is the internal rate of return? How we are going to do it? You can do it in multiple ways. You can use a Google Sheet, you can use your Microsoft Excel, or you can use a mobile app. There are other methods are there. I'm talking about I'm talking about algorithmic tables and all that stuff. I'm not going over there. I'm talking about simple ways to do it, right? The easiest way to do it is use the financial calculator which you saw in the previous slide, right? So, in that I use something called the time value of money calculator, and say that the present value is 100, When you make the money, when you give the money to someone, the money is going from your pocket. So, you put minus 100, correct? And what happens is the future value, that is in 2023, how much you got? 150. So, this will be a plus 150, and you say the period is 5, and then you say 5 annual years, and you want to you made the investment at the beginning of the year. That means in 2018 you made at the beginning of the year. What is the annualized rate? You will come to know the annualized rate is 8.45%. Just click rate, it will automatically give 8.45. So, we had assumed that it's going to be 10%, right? 10% per annum, but the real actual rate is, I would say, it's a 8.4%, which is 16% lower, or 16% of 10%. 16% of 10% is 1.6% lower. So, this is the difference between a simple interest and a compound interest. So, people in real estate will say this is what is happening. My suggestion is use this calculator, you will know what is the CAGR or IRR. So, let me do one more example for you. Mr. Vijay bought a residential plot. In the last one, he bought an apartment. Here he is buying a plot somewhere near Tambaram. Near Tambaram, there is a place called Oragadam. He bought it for 6 lakhs in the year 2008. And this property has appreciated 3 times more, and he was able to sell it for 24 lakhs. So, 6 into 4 times. The cost is 1 time, the return is 3 times. So, he is able to sell for 24 lakhs. We will think that he made 300% returns, right? So, let us see he made 300% returns, and then we will say that the annualized return is 20% every year. Simple interest, right? But my suggestion is that is use the same calculator, same CAGR or IRR. What you do is you say that the present value is minus 6 lakhs, and the future value is 24 lakhs, period is 15, annual, beginning of the year, and then you press this rate, automatically you press this rate, click the rate is only 10%, 9.7%, which is much lower than 20%. So, the most important point is that is please understand the difference between simple interest and compound interest. All these things we learnt in 7th standard and 8th standard, but it's very important that you need to put it into practical use. One way to put it into practical use is to use these two calculators, right? Similarly, you can do inflation. Now, we used to buy groceries and give it to groceries to certain orphanages and all. So, we had tracked all the prices of the essential items. I'm talking about moong dal price in 2008, moong dal price in 2018, moong dal price in 2013. So, we had tracked the entire thing. Similarly, what is the price of urad dal, what is the price of the wheat, what is the price of a ghee and all that stuff. You can use the same financial calculator to find out what is the inflation. right? The first one I am going to say is that is, for example, use the time value of calculator. Moong dal price was 50 rupees in December 2008, which I plugged in over here. Moong dal price is like, December 2013, it is 90 over here, and the number of years is 5, and then I click rate, you will see the inflation is 12.4%. So, an essential commodity price has gone up at the rate of 12.47 between the years 2008 and 2013, correct? But in the next 5 years, if you look at December 13 to December 2008, it's only 0.4%, right? So, same thing, like the next one I am going to give it to you is something called ghee. The price of the ghee was 250, so it's minus 250. The price of the ghee today is 500. I've used the same 500 and I'm putting the period as 5 years, whereas the ghee price has gone up by 14.8% CAGR. So, all these things are required like to understand the time value of money, to understand the impact of inflation. In one of the previous videos, we talked about real rate of return. What is real rate of return? Once you get adjusted for your inflation and taxes, you make the real rate of return. Correct. The other thing which I want to talk about is something called over a 10-year period, what has happened. For example, take the case of black chenna. From 46, it has gone up to 90. So, I put 46, I put 90, but I put 10, 10 years, and then I click on the button rate. What happens is you will be able to see 6.94%. So, the average food inflation is about 7%. That's why even the fixed deposit rates, what the bank is offering is around 6 to 7, because just to cover the cost of money. So, investing in a fixed deposit is not the great way, because you have to pay taxes. When you look at your post-tax return on a fixed deposit, you will be losing money. Correct. And the last example which I would like to give to you is wheat. Take 19 rupees, it has gone up to 48 rupees, and the average inflation of wheat in India over the last 10 years is 10%. Correct. So, now we have understood with practical examples how to do all these things, and learning this financial calculator, you will be able to do it. Thank you very much. I'll come back with you in one more video where I'll be talking about different types of returns. Thank you so much. Thank you.